Just give me
I see it. It
All
says
right,
Jeff
cool.
Bezos. I see it.
All right, so I'm going to start here. I'm going to be briefly talking about here really quick. This webinar usually takes me about an hour and a half, so I'm going to condense some information. I'm going to talk fast because I want to get through this information. This is stuff I've been doing for years, and I think you guys need to know about it. So let's get started here. So,
Mike's all yours, Hubert. Good luck.
All right, cool, thanks. All right, folks, let's go ahead and get started. This is Hubert Centers. I'm going to cover some of my background a little later, but first, I want to talk about a story that you might have heard before, but maybe you don't know how it all got started. And that is in 1994, Jeff Bezos held about 60 meetings with friends, family, and potential investors and tried to persuade them into investing $50,000 into his ideal to create an online bookstore. Now, here's the kicker. Only 22 of them said yes out of the 60. So he failed to convince 38 of them. And 24 years later, some of them still cannot bring themselves to talk about it, what their life might have been had they had taken a chance on this crazy Amazon thing that Jeff would not shut up about. Okay. There's, you can see one of the first, and they're kind of famous for these like door desks. And I used to have a door desk when I first started my first company. And you can see the little Amazon sign there and stuff like that. Obviously, they've grown over the years. Now, the reason they beat themselves up is they just cannot bring themselves to think about what their life could have been like if they would have invested in, Jeff's opportunity there. Now, he says he's still in touch with a few of them now, and Bezos revealed in an interview last year, it's kind of like a study of human nature. Some of them take it in stride and recognize that they have very happy lives, but others just cannot talk about it. It's just too painful. Bezos says some people are just better at rolling with the punches than others. The pain that comes from knowing that they passed on the chance to become potential billionaires. Each of the 22 investors who included Jeff's parents, and let me see, where's the picture of his parents? There's a picture of his parents. His brother Mark and his sister Christina were granted just under 1% of Amazon stock on average. Now, if they had held on to all their shares, and most of them did, and they've also started up a bunch of charities and stuff, they would each be worth over $7 billion each. That's a 140,000% return. I didn't say million, I said billion, 7 billion. Now, am I saying by being an angel investor, you're going to find the next Jeff Bezos and Amazon and be a billionaire? No, I'm not saying that, so don't get it twisted. Is it possible? Sure, it's possible, but it's unlikely. But you could invest in a company that might be acquired by Amazon in the future. I'll show you here in a little bit like how many companies that Amazon buys on an annual basis. And that could be worth millions to you. Now, investing in startup companies, also known as angel investing, early on before their evaluation skyrocket, is the key to making the biggest gains, and it's only attainable through great deal flow and proprietary screening systems. So here's another example. So what we're going to do is we're going to play a little game I like to call Back to the Future. And yes, I know we can't time travel, but humor me for just a minute. All right. So we're going to go back 13 short years ago. And Drew was on a bus between Boston and New York in 2006. And he was a recent computer science graduate from MIT. He was planning on using his 6-year journey to work on some business ideas. But as he sat down on the bus in his seat, he realized that he had forgotten the USB stick that contained all of his files. And he kept getting frustrated that it just seemed like this kept happening to him over and over again. He never wanted this problem to happen again. So with nothing else to do, he started to write some code to fix the problem, having no idea what it would become on to be in the future. Drew came up with an idea of remote storage that users could access whatever and whenever they wanted online. Now, within 2 weeks, he had created a prototype and he came up with a name. And then a few months later, Jessica Livingston, the co-founder of the seed stage investment firm Y Combinator, wrote 2 checks to invest in Drew, one for $3,000 and one for $12,000. These checks are some of the very first investments that helped his company get off the ground. This is known as angel investing. And yes, those are the 2 checks. I grabbed them from her Twitter account. Routing numbers and all. Chick's crazy. Drew's company went on to become, you may have used it before, Dropbox. You've probably at least heard of it and maybe even used it before. Dropbox went public in March of 2018 with an opening price of $29. Dropbox started with a couple of checks written for a total of $15,000, and then And that trade would have now netted her $21 million. Drew still owns 25%. His net worth is now $3 billion. Jessica paid only 3 cents for her shares, a trade worth $21 million for her fund. Now, would you invest $15,000 today for the potential to make $21 million? I know I would. I know I actually do. So Sequoia Capital still owns 23% of Dropbox, which is one of the biggest Silicon Valley investment firms. But they're not the only ones that made huge gains in Dropbox. Dropbox also took money from 95 other investors. Most of the real money today is made pre-IPO, not during or after it. In fact, if you bought Dropbox after the IPO, you would probably have lost money. Unless you were extremely lucky and timed it perfectly, you'd probably lost about 50% of your investment. But not if you were one of the 95 other early stage investors in Dropbox. Now, just imagine if you had the opportunity to invest only $500 with Drew pre-IPO. You could potentially never see the money again. It may just fail and flop and you'll lose your $500. But you say to yourself, he seems smart, he's passionate, he's fixing a problem that's got some scale to it, and you like his vision. So you're just like, all right, I'll give you $500. And besides, in exchange for $500, Drew agrees to give you a small interest in his company. Now, your $500 investment would now be worth over $536,000. Not too bad, right? And here's why this happens. Now, but here's the problem too. Unless you were a person of high net worth or part of a startup investment fund, you weren't allowed to even give him money. He wasn't allowed to ask small investors for startup funds. So you would be forced to wait for the price after the IPO. If you bought the stock on the opening day at $28 to $29, and then you sold it later at a peak price of $43, you would have turned your $500 into a $280 profit. So you'd have eked out about $280 on that $500 investment. That's it, peanuts compared to what the angel investors made on their $500 investment. Now, heck, I don't know about you, but $500, a $200 gain on $500 is a lot less than $536,000. Now, I'm not great at math, but I'm pretty sure one is bigger than the other. Now, you could have paid off debts. You could have traveled more. You could have worked less and done more of the stuff that you want to do. You could have a nice nest egg while you're sitting through the COVID lockdown pandemic. You could basically done whatever you wanted with that money. So what's this mean to you? Well, let me show you. I'm guessing so far you've only invested in publicly traded entities like stocks, options, ETFs, futures, Forex, bonds, gold. Heck, maybe you even dipped your toe in the wild, wild west of cryptos. Because up until 3 years ago, you weren't actually allowed to invest in these unless you were an accredited investor. Now, I don't know about you, but it really pisses me off when someone tries to control me and tells me that I'm not allowed to do something unless it's just there's a really good reason for it. Now, you were not even given the access to invest in private companies until after it already realizes 99% of its potential, the way the market is rigged right now. Sure, you can buy an IPO and maybe catch the last 1 to 10% of a move. The big problem here is most of the growth happens before the company goes public. That is a waste of time and opportunity for your cash. But that's all changed. Now you have a chance to capture the first 99% of a company's growth because of this. Now, this is going to be a little confusing, so pay attention. Thanks to Title III of the Jobs Act, and I'm not a lawyer, but I know how all this stuff works because I do it. All right. Thanks to Title III of the Jobs Act, which stands for Jumpstart Our Business Startups, you may not know what the Jobs Act is. It's not the PPP, the PPPL, and it's not the EILD. This is set in a different motion before all this went down. And if you don't know what the Jobs Act is, that would not surprise me. You might think that the Jobs Act has something to do with jobs, but it doesn't. It's actually an acronym that stands for Jumpstart Our Business Startups. I mean, you got to love the government with all their crazy little acronyms and stuff. They're always making things more complicated than they need to be. In the past, only accredited investors could invest in private companies. And in theory, it was to protect everyday citizens from investing more than they can afford to lose. And it makes sense. Now, If you don't know if you're a accredited investor or not, here are the following rules. Accredited investor is anyone that has earned income in excess of $200,000 individually or $300,000 with your spouse in each of the past 2 years and reasonably expects to make the same cash in the current year, or has a net worth of over $1 million, either alone or together with their spouse, including the value of the person's primary residence. This meant that the majority of Americans were denied the access and the opportunity to invest in startups at all. But now, with Title III of the Jobs Act, which is the Jumpstart Our Business Startups, the Securities and Exchange Commission finally approved the rules, which will now permit startups to finally participate in equity-based funding through approved portals. Think of portals as an exchange for private companies. Now, here's the important part and the potential game changer for lots of people. Title III of the Jobs Act now allows non-accredited investors to invest in offerings for the first time in over 80 years. Finally, the barrier of entry is now basically you got to be 18 years old and you got to have a little money to invest in these type of startups. And you don't have to have a ton of money either. You can get started with as little as $10, but the typical minimums that I look at and invest in, the minimums are $100 to $200, but you can do more depending on your net worth. Entrepreneurs can now sell securities online to anyone who believes in their companies. This law makes sure that entrepreneurs can use online tools to find investors and make sure that the investors can put their money into exciting projects without worrying about getting ripped off, which is really important. Now, the majority of the population, okay, this is the rules. Now, the majority of the population can now invest for the first time in 80 years. Now, here are the following rules. Entrepreneurs can now raise $1 million within 12 months period from non-accredited investors, people that make less than $200,000 or $300,000 a year and have less than $1 million net worth. Investors have to be 18 years or older, would be eligible to invest up to a certain amount depending on their annual income and their net worth. The one unique feature of this rule, these investments can only be done through third-party funding portals to protect investors, and that's really, really key. Now, more investors means more startups, which means more new opportunities for you. You are now free to start unicorn hunting with me and my buddies and join us in the adventure. So I just said unicorn. You may not know what a unicorn is, but you hear the term thrown around all the time. A unicorn is a small company that starts out really small, takes some angel investing funds, and then balloons later their valuation to over $1 billion. Think about Lyft, Uber, Slack, stuff like that. All right. You know they exist. You hear about them all the time. Take a look what Inc. magazine says about this new type of investing if it's new to you. While you're missing 95% of the gains investing in public companies, the shift of value creation from public market to the private market and what to do it. Now, and we're not talking about the typical stock market gains of only 7% or 200%. That's peanuts compared to the returns that you'll have the chance to make as an angel investor. We're talking about 10,000%. We're talking about 100,000%. Now, if this is the first time that you're hearing about stuff like this, you may think this is only for the super rich and the wealthy, that they're the only ones that get in this stuff. And in the past, you would be right. This was only available to a very select few group of people. Let me show you what I mean. Now, once upon a time, excuse me. Let me get a drink. That's better. How's my audio? Audio still good? Slide skills still good, guys? All right, cool. Thank you. Once upon a time, top tech companies like Microsoft, Apple, and Amazon entered the public markets early enough in the public market so that investors could take a relatively good risk to reward bet. When successful, those investors could potentially make some huge returns early from their support. Now, that's no longer the case, but I'm going to walk you through this. So when Amazon's market cap on the day that it went IPO was $438 million, which came just 3 years after it was funded. Now, an investor, if you bought at that price and holding through today, you would have made a 670% return. All right. But just like in the first story I told you about, Amazon's angel investors, those 22 people that invested in old Jeff back in the day, they made a whopping 140,000% gain. All right. Now, today, the above scenario of making money in IPO is just really a fantasy. While tech companies continue to offer some of the biggest returns of any investment category, today's tech companies are deferring their IPO, leaving the bulk of their returns out of the public investors' reach. When you look at this chart, you compare it to the old way of making money, the dark blue, versus the new math of value creation, the light blue. The old way of value creation was to build a company and then take it public, and you can see that in the dark blue. Now, if you look at the chart above, you can see in 1980 on Apple there, which is the first one, about 70% of the wealth was made from early angel investors, and about 30% was made after the IPO. Plus, if you're an angel investor, you have the ability to use the best of both worlds. If you want to hold on after the IPO goes public, you can do it if you want to. Now, look at the second bar right now, which is Microsoft. In 1986, it seems like 12 decades ago, but it's not. In 1986, and you can see that it's the other way around. 80% of it was made after the IPO, and then only 20% was pre-IPO. That's no longer how the game is played, though. Third from the left is Oracle in 1986, also same time a Microsoft went on IPO. This was one of the last ones that made more profits after the IPO. Fourth is Amazon. This is where the game changed. Amazon, 1997, with about 60-40 split. All right. Then fifth, look what happened to Google there. Google, 2004. It is where you see the first big shift where 90% of the profits were made by early angel investors and founders, and the IPO and the public were left with only the last 10% of the move. Sixth is Salesforce, is kind of an anomaly there in 2004. It went about 50-50. And then seventh, you have LinkedIn in 2011. And as you can clearly see, 90% of the profits have been made by angel investors. And once again, the public is left with only the last 10%. The game has clearly changed now. Now, eighth is Yelp. And in 2012, another case here of 90-10, 90 going to angels, 10 going to the public. Angel investors make a killing, and the public investors get a chance to make the last 10%. You got to love Wall Street. Now, number 9 here is Facebook. In 2012, early investors make the vast majority of the wealth, and the public investors, after the IPO, get the chance to make the massive 10% return after the IPO. Then in 2013, Twitter looks the same as Facebook. It's a 90-10 split. And the IPO market is just getting worse because if you tried to buy an IPO last year, you probably lost money. Here's how every new IPO bigger than $1 billion has performed since 2019. You got Lyft here that's down 60%. You got old Smile Direct, which was down more than 60%. And then you got Uber here. Nobody's driving right now. It's down a massive 40%. Peloton, actually, believe it or not, it's actually up since the pandemic because a lot of people are buying these bikes and paying their services. So that 10%, they're actually up about 30% now. And then you've got Avantor, however you pronounce that, down 14%. And then you got Chewy here down 25%. You got Pinterest down 32%. And then the last one was TradeWeb. Last time I checked it, it was up 133%. So they're not that great returns. They're either losses or slight gains. Okay. So there's two things that we can kind of take away from this data. One, the old way of wealth and value creation has changed and shifted to the new way of private angel investing. And second, the amounts of money that angel investors are making are huge compared to the public returns in the markets. Now, the new way of value creation is to start a company and then raise money and then raise the valuation of the company and then raise more money as you grow. And then if you decide to take the company public, most of the returns are baked in and built in for a great exit for both the founders and the angel investors. Now, I call this the angel advantage because really that's what it is. It gives you the advantage or the chance to make bigger gains via skyrocketing valuations. And it's not just for the wealthy, powerful, and privileged that only have access to this stuff anymore. And there's a lot of money at stake. But 99% of everyday hardworking taxpaying Americans are in the dark about these opportunities because they have been locked out of these life-changing deals for the past 80 years. Simply because a provision that was buried in more than 500 pages of new rules. But not anymore. According to Fortune, every time a company like Facebook or Twitter goes public, we hear the stories about the newly minted millionaires and billionaires who invested small amounts of money in the early stages, in the early days. And we get envious, not so much for the other guy's fortune, but because you never had a chance to invest in the first place. Well, that's all changed since the SEC ended an 80-year-old ban. It's certainly a game changer, says investment advisor William Cunningham, owner of Investment Research. Now you have the chance to invest in startups that can go from concept to being worth hundreds of millions of dollars in a blink of an eye as they raise money and they raise their valuations. Now, it only takes one successful exit, and a small amount of money can turn into potentially millions, and for some, even larger amounts of money. Harvard even did a research study that found that angel funded startups had a higher chance of survival. I think it's funny because obviously, if you get money from other people, you're going to have a higher chance of success. But it goes a little bit deeper than that, too. Let me show you what I mean when I say pre IPO. So, as an angel investor, and now this is even further in the process, angel investors can get stuff even cheaper than this. But this was pre IPO, where you could have gotten in Pinterest at less than a penny, okay? And your return would have been 179,000%. Uber, you could have got in for, once again, less than a penny. Your return would have been 541,000%. Then you got Zoom. Zoom's actually larger than this with the pandemic of COVID. Zoom's been going skyrocket crazy. The return pre-COVID was 2,004%, 2,400%. Now Slack, Slack IPO, it says it's a 12,000% return. That's actually incorrect. That's an old slide. I need to update that. The IPO price was about $38. The reason I know that is because I was an early stage investor in Slack, and we got out of it just prior to the IPO. We had an offer and we took it, and I'm super tickled with that. So that would have been about 40,000% return. They're all huge like this. CrowdStrike, you could have got in at like 50 cents, or I should say 5 cents. And then you would have got a 3,200% return. Now, look, if you lost money with other indicators and trading systems or investment strategies from financial newsletters or trade alerts in the past, it may not be your fault. Trading is very hard, in my opinion. I know because I do it for a living. This is an easier way to take a calculated risk for a potential much larger percentage gains. Plus, you don't have to worry about getting whipped around in the markets every day. That's because when you're trading or investing in the public markets on Wall Street, you are usually at a severe disadvantage. First, you're at the whim of the public market valuations, and they can go up and down wildly, as you have seen over the past 2 months. And second, most of the time, you're making the decision on either incomplete information, and you're also competing with the smartest guys on Wall Street. Now, let's face it, most products that are created by quote unquote Wall Street for their clients, actually, they call them sheep on Wall Street, are not in the best interest of their clients. They are usually cleverly designed schemes or ways to separate you from your money. The only exception to the rule, in my opinion, would be if you invested in like an index fund or an ETF index, and make sure that you find one that has a zero or low fee, because they always hide the fees in the fine print and they're always hidden somewhere. So Vanguard's good if you want to do that type of stuff. With angel investing, you're about to see that's totally different. It's a brand new way of making money. It's all about getting ahead of everyone else and collecting big gains. Now, when they get acquired by another company or if they go public. Remember the famous line from the movie Wall Street when the trader Gordon Gekko says, you're either on the inside or the outside. Well, everyday investors like you have always been on the outside when it comes to Wall Street bankers' oversubscribed IPO markup deals. Only a select few got access to those inside deals. All right. You had to have privileged access. The little guy was simply left out of those large type of moves IPO wise. And that model doesn't even work anymore. And I'm sure you've noticed this, right? Well, that rigged game ends today. Now I'm going to walk you through how Silicon Valley beats Wall Street bankers at their own game. You now have a chance to beat Wall Street bankers at their own game the same way Silicon Valley investment funds are doing with what I call the angel advantage. Now, when you think about the uber rich, you probably think about bigwigs or just the founders who get wealthy, but that's not really the case. Let's take a look at the uber rich, all the people that got uber wealthy off of Uber's IPO. So we're going to meet the uber rich. So here's a snapshot of just a few of these guys. I'm going to read you off some numbers that are going to be a little bit mind blowing for you. SoftBank made $9 billion. Benchmark Capital made $6 billion. Travis, the CEO, made $5 billion. Grant made $3 billion. Saudi Arabia's public investment fund made $3 billion. Ryan made $1 billion. Tran made $231 million. Jill, she made $21 million. Dara made $8 million. Ron Sugar, $5 million. John, $5.6 million. Barney, $4.5 million, and 160 others. There are dozens of other investors who have less than a 5% stake in the company. This is all public knowledge. You can find this on their SEC filings. Like I said, there are dozens of other investors with less than a 5% stake. Actually, there's 160 other people that got uber rich off of angel investing with Uber. Now, as Fortune noted, Uber's first round of investment came when they were valued at $1.5 million. By first round capital came with a $4 million valuation. So they raised $1.5 million at a $4 million valuation. Pretty simple math. At $17 billion, they are now worth a 2,000x% return. That means just a tiny angel investment of 20,000 is now worth over $40 million. And I actually know two guys personally that did that. And now, instead of worrying about money, they can now pursue any interest they want full time. Heck, most of them go on to create their own VC firms and just do angel investing full time. Imagine if that happened to you. Heck, just imagine if you'd only invested $500 instead of $20,000 in Uber. You know how much money that would be based upon the math that I just showed you. A $500 investment would mean Uber to you would now be worth over $1 million. You'd be free to do the things you want to do instead of the things you have to do. In fact, write this number down. Everybody write this down. Let me see you do it in the chat box while I grab a quick drink of water because my throat's getting sore here. Write down the number 2 and 20. And when I see a bunch of them go to the chat box, I'll continue here. The number is 2 and 20. All right. All right. So the reason I want you to write this number 2 and 20 down is hot deals like this can close pretty quick. The average close time for deals like this is about 20 days, but hot deals can close even quicker. The quickest deal that my team and I have seen is a little over 2 hours, which is why you need to act fast on this stuff. When these companies make an announcement that they're going to raise money, the impact for them and you can be huge. You can see this. It turns into like a buying frenzy as the close raises or completes its raise. It's like Black Friday at Best Buy or Cyber Monday on Amazon. Only those who get in early will get the best deals. And most people will be left out just because they won't make a quick enough decision. That's why I urge you to get in on stuff like this ahead of the crowd, ahead of the massive buying frenzies that can push the valuations soaring higher. Either you get in now ahead of the crowd or you won't make any money. Now, before I started trading and investing in companies 20 plus years ago, I wasn't born with a silver spoon in my mouth. I grew up in a middle-class family in the small country town of Eastern Kentucky. I also did not start out with a lot of money. I dropped out of college. I'm dyslexic, and school was just really never my thing. I never really liked it. After dropping out of college, I wanted to prove myself, and I wanted to see if I had what it took to make it in the world. I really wanted to test myself. So what I really wanted was freedom and control. And I told my wife to give me 1 year, and I would figure out how to make $1 million a year, and she would never have to work another day of her life. The stupidity of youth. So I maxed out about a half a dozen credit cards to start up a business. What I came up with was as a mobile fleet maintenance company where we did mobile fleet maintenance for companies and individuals. It was like a quick lube on wheels. Well, you probably kind of know how this story ends. It took me longer than a year, but I eventually figured out how to do it. After a lot of hard work, long hours of blood, sweat, and tears, one day I was paying invoices to a local transmission shop for some work they had done for one of our clients. And I watched this guy make $30,000 in 18 minutes. And I was like, dear goodness, how did you do that? And can you teach me how to do that? Now, he ended up teaching me how to do that. And we ended up getting noticed for our work that we were doing by the Chicago Board of Trade, which is now the CME. And they asked us to travel around and teach people what we were doing in the markets and in exchanges, which led to us being featured in all these different media outlets like CNBC, CNN, Forbes, Market Watch, The Street, Bloomberg, Traders Expo, Money Show, Active Trader, Fox, all that good stuff. Now, after I figured out the trading and investing, I started to invest in other people's businesses for either equity or a percentage of the cash flow. And I accidentally stumbled into the secret world of angel investing with startups in Silicon Valley. And it's been one heck of an adventure. And I've learned tons of interesting information from some of the best angel investors in the world with some of the best connections and deal flows out there. Now, that's one of the key things that you're going to need in order to be a successful angel investor. A strong network with lots of connections and great deal flow. And if you don't have that, your chances are making it are slim to none. Now, since I've been investing in this type of technique with angel investing in startups, I've invested in over 30 or 40 different companies. So I want to show you what my current portfolio looks like so you can kind of see how it works. All right. Now, they're not all going to be winners. All right. I think I've had 8 to 10 that have went under. I mean, I lost money in those. But the gains from the ones that hit have more than paid for those. All right. So these are my current exits that I've had so far. This is my portfolio fund exits. And I don't know if you can see the slide. Can you see where it says Slack, Zcash, and Streamlabs? All right. So when you're looking at this Slack, I am proud to report that I bagged my first unicorn exit, which was a exit a company that was worth more than $1 billion. We had a profitable exit. We sold it right before it IPO'd, thank goodness. And then also Zcash, we had a 25 to 69 exit. It depends on when you exited there because you were issued at 2 different times. And then Streamlabs, which is really important right now going through COVID, we exited with only a 2x exit, right? So it's not like they're all big bangers like that. Now, here are the ones that I'm currently waiting on exit. Okay? And that's times my initial investment. That's how much they are now worth, all right? That I actually got a big old fat check from, all right? Now, here's my current portfolio, okay? Now, the hardest thing I will tell you from this being dyslexic is trying to pronounce some of these crazy-ass names that these companies call themselves, like Clearbit, Kartra, Teachable. Teachable is actually, we're getting ready to exit that one at a little bit bigger one. That's an online learning company. Althon, Poshmark, Parttender, Filecon, Chia, Massdrop, which is now Drop, Starkware, Mapillary, Tradeoff. Now, Tradeoff, now you can see the returns, 125x, 44x, 28x, 11x, 10x, 7x, 6x, 6x, 5.8, 4x. You know, Mapillary is only 3.5. Tradeoff is a 90x. That's based on a $30 million valuation on the next raise, which would mean a check of $5.4 million to me if I decided to exit that business. Now, Tradeoff and every other business on here can potentially go to zero. They won't all go to zero. I'll have a 1 or 2 banger hit out of these crew too. Now, when you're looking at these returns, there is always risk involved. So you don't ever put all your eggs in one basket. That's why you build up a portfolio or a fund, as we call it. And you never invest more money than you can afford to lose because some of these things will go out of business. That's just the nature of this type of investing. But like I said, never put more money than you can afford to lose and never put all your eggs in one basket. Heck, I've even been asked to partner up and run my own angel fund. But I turned it down because as fun as that sounds, I would just be making the rich richer. And that's not really what excites me. Helping the rich and watching bankers screw the little guy is not that fulfilling to me. Now that I've figured out how to play this game, I want to share my playbook with you. The bigger impact that I have here is I can now pull the curtain back on Silicon Valley and how they beat the pants off of Wall Street bankers at their own game. Now, for the first time ever, I'm going to share my method to help level the playing field. In order to take advantage of this new opportunity, it is important for you to understand where the money is coming from. The money comes from private sector folks like you and I or other funds that are investing alongside you. They believe in the company's product and service and or their team or their idea, okay? The first thing you should know is that raising valuations come from either growth or future successful raises from other angel investor funds. Now, Title III of the Jobs Act simply created the conditions to unleash your ability to finally get in on the game. For this reason, it's easier for companies to raise money, and it's easier for you to invest or back companies that you really believe in. Now, once you've built your first portfolio of companies, you're going to have to figure out which ones you're going to invest in. We call this your first fund. And this is an example of your first fund with all winners. You're not going to have all winners like this. This is a hypothetical, but I'm just showing you some of them, right? What you need to do is you want to pick about 8 to 10 startup companies that you're going to invest in, all right? That's going to be your first fund. In this example, you're going to take $1,000 and you're going to divide it up by 8 separate chunks of investments. You're going to give each company $125. Now, not all of them are going to be massive winners. Your goal is only to get 1 or 2 big hits and then build a new fund from the profits of those 1 or 2 big hits that you invested in those 8 or 10 companies. Picking just one is a horrible idea. The whole putting your eggs in one basket thing never is a great idea. Once again, I want to make sure that you think about risk before rewards. Never risk more money than you can afford to lose. With that being said, let's walk through an example of how this works. Now let's go unicorn hunting. Now, there's always more money than there are great ideas. First, you want to be super picky and only invest in companies that you believe in and that meet your strict filter criteria, okay? Now you're just going to sit back and keep track of these companies, and most of these companies will send out updates. And now you're going to wait for a liquidity event, which is just a fancy ass way of saying an exit. This is where you get a big fat check. The fun part is where we get paid. Now, there are 3 main ways that you'll get an exit in order to get paid. Number 1, you can sell your interest to another angel investor, hopefully at a higher valuation, so you make a big check. Now, this is becoming more and more popular lately. Second, which is my favorite, is M&As, which is just a fancy way for mergers and acquisitions. This is when a large company gets gobbled up by a little company gets gobbled up by a larger company, and then we get a nice big fat check. This is how it works. So you can probably see the Google acquisition timeline, and this is why this is one of my favorite exits. Big tech companies like Facebook, Google, Amazon, Apple, they all have more money than they have good ideas. So what they'll do is they'll just write a big check to acquire a company, and then they'll launch their products and services that they all to their already existing database. And as you can see here are on the slide is Google's top 10 acquisitions. You got Motorola, Nest Labs, DoubleClick, Looker, Fitbit, YouTube, Waze, AdMob, and ITA. What you don't see is all these little creatures down here. Does everybody see these little gray dots? Everybody just type in dots. These are the ones that are less than $1 billion acquisition or less than $500 million. Everybody just type in dots, gray dots. See all these little gray dots? They buy them up like crazy because they're like, we got so much cash. Let's see if this develops into anything. All right. Now, so we got that. Now, if you look closer, you can see all those little gray bubbles. Now, up next is Facebook. All right. And Facebook, you got WhatsApp, Oculus, Instagram, LiveRail. Can't even say half these names. RedKit, Phrase, Pebbles, FriendFeed. Now look at Facebook. All these little dots down here. They buy companies all the time. And now you have Apple, right? Apple. You've got Beats Electronics, Dialogue Semiconductor. Can't even pronounce that one. Shazam, which is a mobile phone app. PrimeSense, C3 Technologies. Look at all these little dots down here that are below $500 million acquisitions. And last but not least, you got Amazon. All right. And Amazon, you got Whole Foods, Ring, Zappos, PillPack, Twitch, Kiva, can't pronounce it, Love Film International. All right. Look at all the little gray dots here that are below $1 billion. All right. Now, as you can see, there are massive amounts of money available for mergers and acquisitions. In 2019, it was over $1.5 trillion. Now, our third way to exit is if they go public. And in this case, you have to wait 180 days after the IPO to sell. Angel investing now gives you the chance and the best opportunity for someone to transform a small amount into potential millions of dollars. Today, we are launching the Angel Advantage. You can get access to me and my team and our expertise. And most importantly, we have the deal flow, which is key to getting access to the best deals. We will identify the startups that have potential to be unicorns. You can join, and here's what's going to happen when you join. We use a double filter system, one done by the portal that has less than a 5% acceptance rates. They carefully select startups from thousands of applications. The team determines if the startup is a good fit. If they do, they kick off a formal round of due diligence. If they pass, the company will eventually go live. And then every month we take our filters through the portal's filter and filter at another layer. And we filter out hundreds of deals through our proprietary optimal screening system. 99% of the portal ones will not make our strict cut. There are only a few that will make, and then those are our favorite deals, and then we will invest money in them with you. All right. These are the ones that we're going to alert you to. So if you decide you want to invest in them, you can do it. It's really easy. It's like 3 or 4 clicks, super simple to set up an account. If you can buy stuff on Amazon, you can buy a company. Now, you might be saying to yourself, if these deals are so great, why don't you invest yourself? Well, we are. My team and I are going to give you 2 days to buy it, and then we're going to go right in behind you and buy it then too. That's right. Every startup that meets our proprietary formula, our team is going to invest with you and put our money where our mouth is. We're just going to give you 2 days. We're going to tell you like, hey, we like XYZ company. There, you got 48 hours. Then we're going to buy it right behind you if we can grab it after you fund it. Now, here's the great news. We've already selected 3 potential unicorns. Remember, you do not become an angel investor for typical gains of 100, or I should say from 10 to 100%. You can take your chances with the stock market for those types of gains. You should only invest in deals that have the potential to pay you more than that. All right. That way, if you're wrong and it only pays out a fraction of what you think, then you'll still be okay. And then heads up, not all these companies will make a portion of these companies will go under. That's how this business works. But ultimately, we are going to give you the information and the research to decide if you want to invest in them based upon the best deals that are available. But ultimately, it's your decision. Heck, it's your money. No one is going to force you to do anything. That's the way it ought to be, right? Now, your job is to play devil's advocate and to poke in as many holes as you can before you decide to invest and pull the trigger. One great thing about angel investing versus publicly traded companies is the terms are already set. You don't have to do any power negotiations or complicated math. For most startups, the valuations are not subject to the whims of the wild stock market. Last but not least, compared to the last crazy months in the stock market. Now, you also receive the Angel Advantage 101 video lessons to make sure that you understand why we're investing in the things that we're investing in. Each one, we're going to set up a different portfolio. And even if you even if you've never invested in a startup before, you can now join forces with some of the best angel investors and founders with great deal flow. Angel investing is for sure an adventure. There will be risks along the way, no doubt about it, but there will also be some huge gains. But now you have a new opportunity to invest in the next great companies of the future. Now, if you were to invest in a typical Silicon Valley investment firm, the minimums can range from anywhere from 250,000 to as high as 250 million. Now, for the bad news, most of these funds, you either have to know someone on the inside or in order to get an invite, you have to know somebody that's already invested with it. The key to this business is still connections and deal flow. With the hottest startups like Uber and Slack and Beyond Meat, you will need someone to give you an introduction to open the door so that those founders will invite you in to invest. We are here today because we want to help you open those doors. You've seen how you could have made huge returns using this strategy and how I've done it myself. You saw how people are using angel investing and making large fortunes. Now it's time for a decision. The way I see it is you have 3 options. Option 1, you could do absolutely nothing and stay exactly where you are right now. And if you already have enough money socked away to survive COVID and survive retirement, and you're not worried about running out of money during the golden years, you may not need to do this strategy, right? But if you would like to take some investments with a calculated risk that has a chance to leave you with more than enough, then that leaves you 2 options. Number 2, you could do it yourself. All right, so that's the second option of the 3. You can try to keep track of thousands of startups every month and then filter down to the 100 to 200 that make the cut, and then try to analyze all of those that make the cut. And then hopefully you will pick the unicorns or the thoroughbreds and not the donkeys. All right. Now, if you're willing to do the work and spend hours in front of your computer and pay the analytics firm CB Insights, which is a data platform that'll cost you anywhere from $59,000 to $265,000 a year. They also have a one-time account activation fee of $10,000 to help you make a better decision. And you might be able to pull it off. And you thought your data for charts and trading and execution were expensive, right? I've actually used CB Insights data for some of the charts and graphs that I showed you on the acquisitions of Facebook, Apple, Google, and all those others. Option 3 is you can let me and my team do the heavy lifting for you. We'll put our proven proprietary filter system to work for you. We'll do the heavy legwork, send you the research and the alerts. All you need to do is read the research and decide if you want to agree to the terms and then decide to invest in the deal. It's pretty simple. Of those 3 options, you got to ask yourself, well, what's going to be easier for you? You see, there are 2 types of people in the world. There are those that only dream about achieving their financial goals without ever taking action to make it happen. And then there are those who are ready to take action when opportunity presents itself. So most people will tell you that they want to retire rich, but both you and I know very few people will actually make it happen. Most people will just keep dreaming, while the few who are actually serious about their financial future will take action. Since you've watched my entire presentation so far, I think you could be one of the special few ones that make the cut. One of the 25 people that I'm looking for today, if it's right for you. And if you're still with me, it may be potentially right for you. So I'm ready to send you an email with the subject line that says, welcome to the Angel Adventure. So what we've got here is we've got 25 spots available. You're going to get instant access to our current picks. Currently, we have 3 right now. 12 months of Angel Advantage alerts. We're going to pick 2 or 3 per quarter. This is not a day trading service. This is an investment in startups. All right. 2 to 3 picks per quarter based upon the deal flow and the availabilities of the deals. We're also going to throw in the Angel Advantage Investing 101 video course, which walks you through how we filter through these companies so you can do it yourself if you want to. You don't have to. We're going to do it for you. And then we're also going to send you once a quarter the state of the market and investment research once a quarter on what's going on in angel investing. Now, the normal price for Angel Advantage is $5,000. For a short time, you can subscribe as a charter member for half off. So instead of paying the full $5,000 price, you can get the Angel Advantage for just $24.95. Plus, I'm going to make it even better because you made the time to attend this live webinar first thing in the morning, 8 o'clock on a Tuesday here. I should say 9 o'clock on a Tuesday. I'm going to knock off another $500. That means today you can lock in a year of service for only $19.97. As soon as you order, you will receive a username and password to a secure site where you can access the Angel Advantage research and your first potential unicorn. So there are your deal points right there. I'm going to try to attempt to grab a hyperlink to put in the chat box for you, and I'm going to open it up for questions. Hit me with your questions, because if you've never done this stuff, you may have a few because it's kind of a new subject for most of you. All right, there is the link. Here's the telephone number, 859-963-3445. All right, let me see where all the questions are. All right, I'm in my 60s. Are these long-term results? I'm going to be too old or dead before the potential ship comes. So you're going to have to invest in these for at least a year. I've been lucky in this strategy that I've been able to have several different exits within the first 3 years. How much is the typical investment in one of these companies? That's a great question, Clark. You can invest as little as $10. Most of the company minimums are about $100 per company is usually what goes on. Okay. Hey, Jeanette, I don't know how to post the link. I don't think do I do it in the Q&A session or do I do it in the chat? I'm not sure. What's the minimum investment in any company? Once again, it could be as low as $10. Most of them require $100 to $200 investment. What is the track record with accounting statement? What is my track record with accounting statements? It doesn't really work that way. I wish it did. So here is my potential track record right here. This is my potential track record right there. That's the companies I'm invested in and their return since I invested in. And then here's my track record. I've exited Slack pre-IPO, Zcash with the 25 and 69, and Streamlabs. And then I've got these others that are working. It's not like you have a trading statement that I can send you, like an accounting statement. I would have to send you my tax returns in order to do that, right? But that's how it works. And every fund is different, right? Like you can have one fund that only has one winner out of it. You could have one fund that has 4 big winners. How long do I need to wait to exit? So each deal is different. Each deal is different. Some deals will be fairly quick, but you need to think of this as most of the ones that are going to go out of business are going to go out of business first, okay? So, and then you'll have a few that'll make a little bit of money and then they'll grow over time. And then the longer they stay in business, the bigger the exits will be, like we did on Slack and stuff like that. So it's at least a year commitment or more. You're going to do this stuff. You're just going to build your first year, your first fund, your first year is what you're going to do. All right. Your first fund of 8 to 10 investments. And then you watch those things. And then the money that you make from those 10 investments, you then start up another fund. This is not just a one-hit wonder. Like everybody that got rich off of Uber, there's a reason why LinkedIn is successful. He used to work at PayPal first, right? Are you basically aggregating multiple investors and the main investors release the capital? No, who pays the proceeds and when we sell IPO? So when you do it, we are each individually investing in the companies. I'm not taking your money. The portal, like think of the portal as like the NASDAQ for public companies or for private companies. You have your own individual trading account in companies. I have my own individual account. The price for the Angel Advantage is $19.95. That is correct. I don't touch your money. The portal takes care of all that. I don't get any affiliate kickbacks or anything. I don't invest in the portal. What we do is we're selecting the deal flow and we're going to invest with you. Do your investments go through you or do they have to create an account with each company? They just go through the portal. All right. So you're just going to have one trading account and then you can invest and buy these companies. You can say, hey, that one looks interesting. Boom, I want some of that. Hey, that looks really interesting. Boom, you're going, dear God, that looks like death. I don't want to touch that one. That sounds like a terrible idea. I'm not going to invest in that. Do you tell us when to exit? We don't really have a say in that because we won't have board access. We don't get voting shares. You're just going to be an angel investor in a company. If Google decides to buy your company that you invest in, they just send you a big fat check. That's how you exit. Like you don't go like, no, I don't want to take the $4 billion that you're wanting to take from Google to buy you out. They're like, we don't give a shit what you want. Here's your money, right? Now, if they go IPO, then you can decide to either sell at the IPO after 180 days or you can hold it forever. But if they get acquired by somebody else, they're just going to send you a big fat check. Now, the hardest thing is trying to pronounce some of the stuff that you're going to invest in. And the second thing is you'll get checks from some companies that you won't even remember investing in. You're like, what is that $20,000 for? What is that? 150? What is that? From who? Oh, okay, cool. They finally made it. Do you tell us when to exit? I already covered that. How does this differ from penny stocks? Penny stocks are publicly traded companies. These are privately traded companies. They are not on a quote unquote exchange. They're on a portal. So I think NASDAQ is opening up their own individual exchange too, and they're going to compete with some of these portals. So it's going to be bigger and bigger. So you're investing in them even before they're penny stocks. Does that make sense? You provide the names, but no management or money handling. Correct. That's correct. I'm going to provide the names. I'm going to tell you based upon the people that are helping me do this and that are on the advisors of my fund and my track record of doing this successfully, which I'm friends and buddies with some of the best angel investors in the country. We're going to show you like, Harry, there's the ones we'd invest in. Then I'm going to alert you to it. Then I'm going to give you 2 days and then I'm going to go right in behind you and then buy the same thing unless it closes before that. Hopefully that doesn't happen. So that's correct. Yep. How many are on your team? We've got me, Jared, Karen, and then I've got 3 advisors. Will we get a 1099 or K1s when we sell shares pre-IPO? Depends on the deal. Depends on the deal and how the deal is structured. You could get one or both. On some of mine, I've done a lot of accredited investing stuff, and I got K1. But you may not get a K1. You may get a 1099. It depends on how the deal is structured. Each deal is slightly different, and we'll do a write-up on that. All you have to decide is like, hey, do I want to throw $100 at this thing? Do I want to throw $500 at this thing? The cool thing about the portal is they protect you. They're not going to let you overinvest. So let's say that you make $30,000 a year. They're going to be like, all right, you can throw $2,000 this year at startups in your account. So they're not going to let you go crazy and just gamble. They're going to say, hey, based upon you make $30,000 a year, you can they'll do a sliding scale and say, we're going to let you invest $2,000 or $3,000. Can foreigners invest in American car startups? Yes, they sure can. Yes, that's not a problem at all. Yeah. Uh-huh. All right, I'm gonna put the link up here. I don't know if y'all can see it right there. It is. Think. Oh, you can't click on that. That's weird. How do you so take the WW off? Hey, Jeanette, how do I do a link that is clickable? I don't know how to do it. The HTTP one. Oh, what is the difference from your service and other services? So I'm not a portal. I'm just telling you what I'm investing in based upon my track record. Do you get an exits? Just sell a holding up. You can sell on the open market if that's available as an IPO, or you can hold and past your 180 days, or you can potentially even sell it to another angel. All right. The minimum hold period is a year. Yep. Do I get shares and how's my ownership documented? It's documented on the portal and you'll get a certificate of it. Yes. Okay. I've been answering the wrong questions there. How do you exit? I got that one. How do you got that one? What is the difference between got that one? How do you exit? What is the minimum investment? Got that one. Minimum investment is different for every little deal. I've seen them as low as $10. I've seen them as high as $1,000. But for the most part, on the portal that we recommend and use that has one of the best deal flows out there, is their deal flow is about $100 to $200 a pop per investment. So if you want to just think about it, if you want to invest in Amazon, and heads up, you're not going to invest in Amazon. You're going to invest in companies that will be the next Google or Facebooks or Amazons, and they maybe get acquired by those guys. That's what you're looking for. Okay, so can you sell to other investors who isn't in the portal? Well, you it depends on the deal. The short answer is yes, you potentially could. You could just transfer that over. But an easier way to do it was just have them do in the portal, and the exchange on that would make it a little bit easier. Yeah, there you go. There you go. Thank you for posting the link. I appreciate it. I'm a moron. I didn't know how to post it correctly. There you have it. All right. You can also call my team, 859-963-3445. There you have it. All right, I am going to keep us on time here. We got 3 more minutes. So if you hit me with a few more questions here, because I know Jeanette's going to have to do a transition here in a little bit, and Raleigh, does the portal charge for their services? They do. They charge for their services. They don't charge you. They charge the company. So let's say that we all had a company and we were going to say howtokillcovid.com, right? If we started up that company, they're going to charge the company to help raise their money from us. They're going to take a 2 or 3% cut of that money, but it comes out of the company's pocket, not our investment. And then they also get a percentage ownership in every company that's on their portal. Okay. Once you get the name, how do you do further due diligence? That's covered in all the course. The portal does due diligence, and then we do due diligence too. Like there's hundreds of them right now on the portal. Last night I looked and there's 35 new deals. Out of those 35 new deals, I would only pick 1 or 2 out of those, even though the portal is super, super filtery and they use their own due diligence. We take it another layer and go, hey, I don't agree with that. Here's why I wouldn't do that. Like, here's some tips. You never want to invest in a company that has more than 3 founders. There's no way 3 people can ever agree on anything. You don't want to have 2 founders that have the same job, marketing or programming. You want one marketing and one programming. You don't ever want to give money to anybody that goes, we have no competition. That's bullshit. Everybody has competition. You don't want to say, hey, just give me $10 million and I'll go be the next Google or the next Facebook or the next Apple. You can't, that's not how this business works. And people are delusional, but they'll just ask for money. And a lot of people just give them. So it's really, really important to make sure you know how to filter out a good opportunity versus a bad opportunity. We call it figuring out the donkeys from the thoroughbreds, and then figuring out the thoroughbreds from the angels or the unicorns. Once you enrolled, are you paying a membership fee every year? You are to us, yeah. But my goal is after you have your first fund, that you make enough money that you don't have to pay us. But also, it's twofold, right? If I make you enough money with our picks and our investments after your first fund, you're probably going to want to know how we keep doing that, right? Because we're relatively decent at picking these things. Not all of ours work out. Out of the 30 or 40 different investments that I've had, about 8 of them went to zero. They just went out of business. That's part of the business. Like, like if you invested in Bob's burger joint, it's got a potential going out of business. So you're not always going to be winners. That's impossible. But your thing is to pick 1 or 2 really good ones out of your portfolio of 8 to 12. And that 1 or 2 big winners will pay for all the other in your portfolio. Can you pay for access to the learning tools before joining the service? I don't know if I have enough capital to invest right now. but I want to learn. Unfortunately, we don't have a trial, and it's a 1-year commitment, and you have to be in these investments for a minimum of a year before you can do it. Yeah. So unfortunately, no, we don't have that access. So you also provide the required information for us to be able to independently select good picks later. Yeah, the entire video course, we're going to teach you how to fish, and we're going to fish for you. So we're going to do both. So as we're doing it, we'll have an intensive write-up and showing you why we're picking what we're picking based upon our criteria. And then also, if you want to do it yourself, you can do it yourself. Have you ever met the entrepreneurs developing companies to see firsthand their integrity? Yeah, a lot of times we'll do interviews with them. We'll call them up and talk to them. And if something sounds fishy, we'll try to avoid it. Yeah. All right, guys, I'm out of time. It's 10 o'clock. I don't want to take anybody else's speaking spot. Good luck with the trading today. I hope you guys join us in the Angel Advantage adventure. Payment plans. We do have payment plans. If you call the office, they'll take care of you. All right. Do you mean if I send money and invest you will trade for me just like getting profits is always? I'm not going to invest your money. You're going to invest your money. All right. I'm out of time, guys. I wish I could spend more time. You guys still have tons and tons of questions. But I'm gonna.
All right, Hubert, I'm here.
All right.